This video gives you some signs and indicators that can be used to measure personal financial success. The first indicator that we're going to look at is the expected net worth formula from the Millionaire Next Door. The formula gives an expected net worth total that is based on a person's age and income. The formula is your age multiplied by your pre-tax annual household income from all sources except inheritances and then divided by 10, and that equals your expected net worth. I'm going to use our net worth as an example, and here's how we're going so far. In our net worth, I track our home equity, our investments, our retirement accounts, and cash we have in the bank. And currently our home equity is $710,000. Our investments, once we subtract the debt, is worth $71,000. Our retirement accounts are worth $355,000. And then we have $71,000 as cash in the bank, which gives us a total net worth of just over $1.2 million. As my husband and I are different ages, I'm going to do two different calculations. But first I'll split that net worth, so $600,000 each. My husband is 42 and I'm 37. So for my husband, if we multiply his age of 42 by his income and then divide it by 10, his expected net worth is $462,000. And for me, using the same calculation, my expected net worth is $296,000. In the Millionaire Next Door, there are three different categories based on a person's expected net worth. There is the UAW, which is the under accumulator of wealth. Then the AAW, which is the average accumulator of wealth. And then the PAW, which is the prestigious accumulator of wealth. For the under accumulator of wealth, their net worth is less than 1/2 of their expected net worth. The average accumulators of wealth, well, their net worth is on par with their expected net worth. And then the prestigious accumulators of wealth, well, their net worth is twice their expected net worth. So for us, according to our calculations, we are average accumulators of wealth. My husband's expected net worth was $462,000 and mine was $296,000, which makes a total of $758,000. So we're not quite prestigious accumulators of wealth, as our net worth is not quite twice our expected net worth. Our total net worth is $1.2 million, and to be doubled our net worth, well, it would need to be $1.5 million. Save Millions has an expected net worth calculator on their website that automatically calculates your expected net worth for you. I'll leave a link in the video description. And of course, if you are enjoying this video so far, don't forget to give it a thumbs up or write a comment, because it really does help to support my channel. Something else to consider is a person's liquidity ratio. Liquidity refers to how easy it is to convert an asset into cash. A liquidity ratio indicates the number of months that an individual or family could continue to meet household expenses by accessing their liquid assets. Napkin Finance has a great graphic that explains liquidity. It's the ability to turn an asset into cash, easily, quickly, at low cost, and for market value. Liquid assets includes things like cash, money markets, bonds, stocks, ETFs. Illiquid assets include things like art, collectibles, and real estate. The formula for calculating the personal liquidity ratio is accessible assets divided by monthly expenses. And that equals how many months a person's expenses will be covered. Many experts recommend having 6 months worth of expenses in highly liquid assets like cash to cover emergencies that may pop up. When I think of emergencies and liquid assets, I think of two different scenarios. There's those emergencies that the experts talk about where 6 months worth of expenses are needed. This would be short-term once-off emergencies like temporary job loss or a once-off medical expense. This is when I would access our extremely liquid assets like cash. Then there is what I would call an extreme emergency, which is what I would consider a longer-term emergency. This could be loss of income for an indefinite amount of time. This is when I would access our somewhat liquid assets like our stock market investments. So let's see what our liquidity ratio will be with just using cash. That would be that $71,000 divided by $5,700, which is how much we spend each month. So just using cash, our liquidity ratio is 12.45. That means this would cover 12 months worth of our expenses. So this more than covers the 6 months that we mentioned previously. And then if we include cash and our stock market investments, this would cover 24 months worth of expenses. I don't think we can put an exact number on what I call the more extreme emergency situation, as that would come down to that sleep well at night factor. Personally, I'm happy with 2 years, especially because I know that it will grow in the future as we continue to invest. And then there's the good old savings rate, which is savings divided by income times 100 to give a percentage. Here is our savings rate for the year so far. And so far we have an average of a 49% savings rate. This does not include money that we are contributing to our retirement accounts. CanStar has a great little graphic that shows how much Australians save each month. 17% were unsure how much they saved each month. I'm not sure if that's a good thing or not. Anyway, if we look at those percentages, 21% of people were saving nothing. 26% were saving up to 10%. 16% were saving up to 20%. And then, well, you can read the other percentages for yourself. If we look at the percentages, people saving up to 20% to 30% are above average savers. And then those saving up to 40% or higher are well above the average saver. And then there is a person's credit score. A credit score is a number that depicts a consumer's credit worthiness. The higher the score, the better a borrower looks to potential lenders. So why is a credit score important? Well, your credit score is one of the factors that helps a bank or a lender determine whether to accept your loan application, how much they're willing to lend you, and depending on your score, it could also impact the term and the interest rate that they will offer. I used WeMoney to find out my credit score, and they used 2 different providers and both of them came out as excellent. And I thought it was quite interesting that they also compare my score with other members. On WeMoney, the average member has a credit score of 614. The next sign or indicator of financial success is a person's debt-to-income ratio, which measures a person's ability to manage their debt payments each month and repay the money that they have borrowed. So what does this mean? According to Investopedia, a low debt-to-income ratio demonstrates a good balance between debt and income. In general, the lower the percentage, the better the chance you will be to get a loan or line of credit that you want. A high debt-to-income ratio signals that you may have too much debt for the income you have, and lenders view this as a signal that you would not be able to take on any more obligations. The formula for calculating the debt-to-income ratio is monthly loan repayments divided by monthly gross income. And multiplying that number by 100 will show the debt-to-income ratio as a percentage. Because according to that Investopedia article, lenders prefer to see a debt-to-income ratio smaller than 36%, with no more than 28% of that debt going towards servicing a mortgage. So let's see how we compare. Our monthly loan repayments, including our investment loans, are $3,547. So if we divide that by our monthly gross income, including income from our investment income, and then multiply that amount by 100, we get a percentage of 20.46%. So it looks like we are under the recommended 36%. I was surprised by that, as we always have trouble getting finance. I think that is probably because my husband is self-employed. I hope you enjoyed this video and thanks for supporting my little YouTube channel. Don't forget you can also find me on Instagram and Facebook.